All right, now let's go to the today's topic, which is recaps of what we can do with life insurance license. So these are the some of the highlights of our businesses is consist of. All right, so with our life license, obviously we can do life and annuity. I mean, in general, life insurance covers when you're dead, when the client is dead. Annuity covers when you're living. So life and annuity covers dying too soon and living too long. I mean, that's a basic idea. On top of this, we have a critical illness, long-term care, disability insurance. So those are the type of product that life insurance company covers, but they always have a life insurance and annuity, right? I mean, some company they only have a life insurance. Some company they don't. They only have annuities, but more than likely, most company will have life insurance and annuities. Okay. So as I was saying, one premium, and that has coverage for death benefit. So it covers dying too soon, and it also have supplemental income, so cash accumulation. So that can be used anytime. So this, and a lot of times they're using it. One of the main use of this cash value is supplemental retirement income, so which takes care of living too long. I mean, that's the two main risks: dying too soon and living too long. And it also covers becoming sick. So it has a terminal, critical, and chronic illness. I'm not gonna explain what they are. You already know. When it comes to living benefit, one of my favorite product is Columbus Life. There's pros and cons of all product, but thing about Columbus Life is using lean method, and so you know exactly what you're getting, and the illustration shows um, your benefit amount year by year, so you have the full disclosure, and that's why I like it. But there are other things that I like about National Life also. So it all depends on the situation. But anyhow, this is a Columbus Life is a living benefit. So IUL with living benefit. So what's the good thing about one of the reason for a few of the reason for IULs? I mean, cash value accumulation, as I told you. Index means that it is utilizing index option. So you have growth potential. So the rate of return that you're going to get on cash value will be typically higher than fixed rate that insurance company or banking system is giving you. And not only that, because we're using index option, when there's a downside downturn of the market, stock market that is, you get zero. So which means you're not losing your money. So worst you can do with the index investment is that you get 0%. 0% means two things. We in this industry we call it zero is your heroes. Uh, Zero means two things. Number one, you will not lose your principal. Keep that in mind that we're talking about IUL, life insurance. There's a cost involved with insurance, so that we're not talking about costs involved with the insurance. It is a beside the discussion. But what we're talking about is when we deduct all the costs associated with the life insurance and whatever the net amount that's being um, invested in cash value, whatever that is going into the cash value, you will not lose a dime on investment. So if stock market crash and market went down negative 30%, you get zero. Means if you put $1,000 in, your $1,000 is still safe. That's one thing about 0% return. The next thing about 0% return is that not only that you're not losing your principal investment amount, you're not losing the gain you had up until that point. Let's say you put $1,000 in and you had a gain of, let's say, $300. So your $1,000 is now 1,300, and market went south and stock market went down, and let's say it hit negative 40%. What's gonna happen with your $1,300 is that $1,300 will remain 1,300. So your original investment of 1,000 is protected. Your gain of $300 is also protected. Okay, let's say after that 20-30% of crash and it went back 10%, you get 10% gain on 1,300, not 10% gain on the original $1,000. So it is a very creative and protective way of growing your asset. So it eliminates the investment risk. Okay, and when it comes to investment, there's two type of risk. You have investment risk, so you losing money on market, and another risk is that if you go too conservative on your investment strategy, and you're not getting good rate of return, you're also exposing yourself to inflation risk. Inflation risk means that the rate of return on your money is not keeping up with the inflation. Now, when you're putting your money in index account, more than likely, because that's what history is telling us, more than likely you'll keep up or you'll outperform than rate of inflation. So you're eliminating investment risk and you are probably outperforming the inflation. So you're also getting rid of inflation risk. That's a good thing about index. So index product is not only, I'm going to talk about annuity product later, but it not only this applies to life and it also applies to annuity, but life insurance, number one, we have a good cash value accumulation with managed volatility. Number two is that living benefit. Almost all the insurance product that we're dealing with, we love living benefits. So we're dealing with the critical, chronic, and terminal illness already built into the product. And 99% of the time, this rider is free. The client does not need to pay. I mean, there are times that client wants to pay. I mean, we can get that product also, but most of the product that we're selling are free of the charge when it comes to living benefit. And the number three, you can access cash value anytime, and you can use it for any reason, and it is completely tax-free. So two ways to access your cash value. One is in the form of loans. You're taking loan out against your cash value, so it is not on withdrawal, so you don't have to pay tax on it. On the original principal that you have put in, all the payment that you have made into life insurance policy can also be accessed in the form of withdrawal. And when you're taking out, when you're taking a withdrawal of your original principal investment onto the life insurance policy, more than 99% of the time you are investing, your money is contributed into life insurance account is already taxed, right? You're purchasing life insurance with after tax money. So when you take the money out, when you're withdrawing your original investment, what's tax on this? There's no tax because it's already been taxed. So there's a tax-free withdrawals and there's tax-free policy loans, and because it is a withdrawal, because of the provision, you can take money out anytime. There's no such thing as a age 59 and a half restriction. There's no such thing as you have to use it for certain usage. You can use whatever in any which way you want, and there's no tax penalty on it. Okay. And a lot of times IULs and terms and the way we're going right now is that most of the life product, there's no medical exam. I mean, if it is a big amount, like your client is purchasing $5 million, obviously he need to go through the medical exam. But if it is under $2 or $3 million, depending on the age, there's no need for urine and blood. Okay. And another product that we can present to our client is GUL. What GULs? Guarantee Universal Life. Easiest way to understand GUL is a GUL is a term insurance, but their term duration of the insurance is whole life. So I mean, client can dial in. They can say, I want a set amount of premium, guarantee premium and the coverage lasts until age 90, 95, 100, 120. So they can choose any which way, but the premium is guaranteed. More than likely, GUL will have a very little or no cash value, but this will be a great term insurance alternative. Okay, so the premium is guaranteed for life, and there are options also. You can do 10 pay, 20 pay, 15 pay, 17 pay, however you want. You can pay up. You don't have to pay lifetime. Okay, so there's that flexibility, and those people who are really familiar with term insurance, GUL is the easiest way to do it. It's more expensive, but it covers your lifespan. And not only that, it has a living benefit. Our term has a living benefit also, but it has a living benefit. And some of the product that we're dealing with has returnable premium. I love Anyco's GULs because it has like 15th year. Client can cancel and get, I believe it's a 70% of their money, or if not 50%. I don't remember, but you get part of the money back on 15th year, and you have another chance on 20th anniversary. On 20th anniversary, if you want to cancel it, you can cancel it, and you get to collect all your premium, 100% of premium on 20th anniversary. And there's no more policy, but you got your life insurance for free for 20 years because you got all your premium back. And there's another chance on 25th year, you get 100% of your premium also. So if you're into term insurance with a return on premium rider, and you know that there aren't that many insurance company doing ROP terms, but there's still ROP GULs. Okay, and just like IULs and traditional UL, there's no medical exam. And we have a LIR. What is LIR? Lifetime income rider. This now we're running into annuities. See, annuities. Most of the insurance product that we are selling, the annuity product we're selling, like this one is particularly gear showing Anyco's Asia Plus. Anyco's is fixed index annuity with a lifetime income rider, guarantees 6.85% growth per year for next 10 years. It's guaranteed. However, that guarantee rate of return is not on account value, but it is on income value. We talked about difference between income value and account value. Means that whatever that 6.85% has grown into, the client can start anytime he chooses, start receiving lifetime income. And they will calculate the lifetime income amount, and client is guaranteed to receive that amount as long as he lives. If he lives 50 years, he'll get that amount for 50 years. If he lives 10 years, he'll get that amount for 10 years. Now, if he lives 5 years, he'll get that amount for 5 years. Now, if more than likely, if he only receives it 5 to 10 years or even more, there should be a little bit of account value left. Whatever the account value is left, that amount of money that is left in account value will go to the beneficiary. Now, what if you live long time? And as I said, let's say once you start this retirement lifetime income rider and you live 30 years, in about 18th year, your account value is now zero because you have taken all the withdrawals. Even that case, the promised retirement income amount will be paid, even with zero account value. Now, from that point on, there will be no death benefit because there's no more account value. But you know for a fact that you are receiving lifetime income from that annuity. So that's one thing that we can have. Another thing is increasing income option. If you choose to, you can also have this income option. More than likely, it'll start at lower amount than lifetime income rider's amount. However, the difference is that you get that guaranteed amount, but every time, anytime you have triggering event, it could be you can set it up for 3% annual growth to keep up with the inflation, or you can set, hey, it is in the it is linked to the index, so index linked amount. So a lot of time people love in the index linked amount. So every time your index option has positive return, then your guaranteed lifetime income amount will increase. And it will never decrease. So let's say you start with a $5,000 a year income, and index it, you experience a good index return, and let's say you went up 10%. Next year you get 5,500. Or even more, depending on the contract. But from that point on, it's no longer 5,000 is guaranteed. It's a 5,500 that's guaranteed. And a year later, let's say you went up another 10%. Now you get what, about $6,000? So your income increases as long as your index is experiencing positive rate of return. And when the index is experiencing negative return, what are you going to do? I mean, number one, since we're dealing with the index option, when the market is going negative return, what do you get? Zero. So what happened to your retirement income money? It doesn't increase, but it doesn't decrease either. So it stays the same. Okay, so that's the increasing option on the income riders. The third one, double your withdrawal amount with the enhanced income benefit. That's when you're confined in qualified care facility like nursing home and stuff. But as you already know, California Department of Insurance is rarely approving this rider. So this rider is for non-Californian agents and clients. And we do have a product that also offers this within California, but I do not talk about that product because it's a B-rated. I don't normally recommend a life insurance company that is B-rated. I want to deal with A-rated company. There are enough A-rated companies. Why bother with a B-rated company? Fixed index annuities. When you're into, we talked about income side. Now we're going to talk about accumulation side. I mean, this is N equals Asia plus, their highest run on 10 years. I mean, how do you like having a growth, your money growing at 11% 1 year, 14% next year, 2% next year, 4% next year, 3% year after, 14, and you get zero. When you're getting zero, that means market is going negative, but you get zero. And 13, 16, and 15, and this is equivalent of getting 9.65% per year for that 10-year time frame that we're looking at. Where can you get 9.65% positive return with a guarantee of never losing original principal or never losing gains that you had up until that negative market? That's fixed index annuity for you. Okay. There are people who are saying that, hey, I don't care even if you guaranteed 0%. I want to stay away from market. I mean, there are some agents very stubborn. I mean, no matter what you tell me, I want to have a guarantee all the way through. From A to Z, I want everything guaranteed. That for the client like that, we got something called MIGA, multi-year guarantee annuity. Now, if you look at 3 years, if client is putting away $250,000 and more, they're guaranteed to get 3.9% per year rate of return for next 3 years. So he's getting 3.9% this year, 3.9% next year, and 3.9% year after. And after third year, you can go to somewhere else and look for shop for different rate of return. But this is guaranteed. Let's look at 7 years and you got $100,000. If you look at 7 years and 100,000, it's a 3.8%. So you got 3.8% compounded interest for every year for next 7 years. Now try to get 7-year CD. I don't know whether there's such thing as a 7-year CD. 7-year CD guaranteeing you 3.8% per year for next 7 years. It'll be very, very difficult, if not impossible. Okay, that's MIGA for you. And final expense, we talked about final expense. This is type of product that actually for elderly people. As you can see, this is up to age 85. So when it comes to final expense, the death benefit amount is small comparable to a traditional UL or whole life. See, 0 to 55 maximum amount is 50,000, 40,000 for next 10 years, and 30,000 for next 10 years, and 25,000 maximum for next 10 years. So this is strictly, a lot of times people are getting this so that they'll do the final planning. Okay. There are 3 underwriting methods. One is simplified underwriting. Simplified underwriting is that underwriting, there is underwriting, but it is simpler than traditional life insurance underwriting. So it's easier to qualify. Even if you don't qualify for simplified underwriting, there is a graded underwriting. I don't want to call it underwriting. Graded benefit. What it is that if you fall away, if you're not qualified for simplified underwriting, they put you in this program that's called graded benefit. Graded benefit means that you're not getting death benefit within first 2 or 3 years. This particular one that I'm showing you is 2 years. If death happened within 2 years of from the issuance of the policy, you're not going to get your premium. You're not going to get a death benefit, but what you're going to get is that you're going to get your total premium that you have put into the policy plus 10%. Now, if death happened by accident, accidental death is covered even for the first 2 years. Okay, but if it is a natural death, you're not going to have a coverage. You only get return of a premium plus 10%. But even then, that's not bad. Now, if client dies after 2 years and 1 day, he'll get his full death benefit. Well, actually, he's not going to collect. He's no longer here. His family will receive the death benefit. So that's second way. Third way that is not listed here is a guarantee issue. Guarantee issue is that if you're bleeding, they'll write your life policy. More than 99% of the time, guarantee issue is also graded benefit, so you're not going to have death benefit for either 2 or 3 years. That's typical. And you get your premium back if death happened within that time frame, but after you get full death benefit. But premium is higher. So simplify, and let's get it straight. Traditional is cheapest. Simplified is a little higher, more expensive. Graded benefit is a little more expensive. And guarantee is most expensive. Okay, so we can do the final expense. Premium financing. I'm thinking about doing premium financing next week. Premium financing is, as the name says it all, is financing your premium. If you're making $100 a month, is there a need for premium financing? Probably not. What if you're saying that, hey, I'm going to max fund my life insurance and I'm going to put away about $80,000 a year? Do you think it makes sense to borrow that $80,000 or portion of that $80,000 and put it into life insurance? Yeah, it is doable. There's such thing as a premium financing. And there are 2 different types of a premium financing. One is, hey, I want to max fund my life insurance. A lot of times it's IUL. And I want to max fund it. I want to use someone else's money. And one of the very popular one is something like this. First 5 year client pays half of the premium. The lender pays another half. Next 5 years, lender pays 100%. Meanwhile, since it is loaned money, does the owner have to pay interest? Yes, he needs to pay interest. There are a couple of ways. He can actually pay out interest, or he can just let it grow so that the loan amount will grow. So original loan amount plus interest will grow and grow and grow and grow. So it gets bigger. Now what that program will do is that it's not mandatory, but if client choose to, he can take cash value out around 15th year. That's what they're designing. But you don't have to do it in 15th year. It could be in 20th year, whatever. But you don't want to have that interest growth too big. So on 15th year, what you do is that your cash value has grown enough so that it'll be more than enough to pay off the loan. So you pay off the loan. Then you have the policy all to yourself because there's no lenders on your back. That's one way to do the premium financing. Another way to do the premium financing is super rich people. Let's say they're purchasing life insurance for $20 million and premium came out to be $200,000 a year. Can they afford it? Yes, of course they can. Do they want to? Probably not, because they want to leverage OPM. What's OPM? Other people's money. So a lot of times they said, okay, I'm going to pay interest and I'm going to let the lender pay for this. And on that situation, more than likely, the lender will collateralize his asset. The previous one, a lot of times there is no collateral other than life insurance policy. This big, super heavy life insurance, probably there is a collateral, but they're willing to do it. So these are the type of product that we can do. Next week, I'm going to talk about Kaizen, one of the small premium financing, and it is doable for everyday Joe. If your income is more than $100,000, so that's premium financing for you, leveraging your money and purchase IUL. Foreign national. Why think about foreign national? Foreign national, as the name says it, foreign national means that non-U.S. citizen coming over and purchase a life insurance from U.S. Why do they want to do that? Number one, more than likely, a U.S.-based insurance company offers cheaper insurance costs. Cost of insurance is cheaper. Number two, better cash accumulation. The cash value accumulation is better in U.S.-based company. And number one, we're using most reliable currency at this time of the right? What's the most reliable currency? Dollar. Where is it from? U.S. So you're looking at very stable and having a good growth potential. So that's another thing they love about U.S. Based companies. And the next thing one is that U.S.-based company, they don't mind writing a big ticket life insurance, death benefit. Okay, as long as you're financially insurable, they'll let you have $20 million, $30 million life insurance after the underwriting. But some countries, there's a limit on amount of life insurance you can have. I don't know what the situation is with Japan, but I heard from Korean insurance agents. In Korea, there's a maximum amount that one person can have. Maximum death benefit amount that one person can have. That is combining all the life insurance. Not only from one company, but combining all the life insurance policies he has, he can only have a certain amount. If it is more than that amount, I heard that he cannot purchase it, but he can come here and purchase from national life insurance. You do have to have some U.S. connection. We call that LexisNexis. I found this company. Their LexisNexis is $25,000 in U.S. bank for more than 30 days. That's really easy. More than 25,000. If you have a banking account opened up and the average balance is more than $25,000 and that's been there for more than a month, you can purchase a life insurance. Okay. And here's the good news for some of you. And this is business that you can do even for Japanese citizens. Japanese citizens are one of the hardest to get foreign national life insurance policy because the government do not allow it. But this company is owned by Sumitomo Bank in Japan, and it is U.S. based. So I heard that Japanese government don't mind having foreign national life insurance with that company. Okay. Uh, College funding. You can do college funding with a life insurance using cash value. So that way you do not have to report it to this cash value amount to FAFSA application. Even if you wanted to, there's no line to write down the cash value amount on the FAFSA application. For those of you who do not know what FAFSA is, free application for student aid. That's the acronym. That's what FAFSA stands for. That's the application that goes to U.S. Department of Education, and from there, whenever whichever school that your children or your grandchildren is going, they'll send that database to them. So that's where each school is calculating needed financial aid. So which means that if you have some big money in savings account, you're not going to be eligible for big financial aid. But if you have a big cash value, it's not going to affect the financial aid amount because you're not reporting that. So that's why some of the insurance companies use life insurance as a college plan. And another thing is that you do not have to use it for college, and you can use it for anything else, whatever the cash value you have. It has a living benefit. I mean, if you choose the right product, it has a death benefit for the adult. I mean, I do see a lot of some agents recommending life insurance on the child, but I don't recommend that unless I see the need and unless I see that adults are fully insured with enough death benefit. This is a typical question that I'm asking if a client comes to me and say that I want to have a college plan oriented index universal life. I want my son to be the insurer. Then I'll ask a blunt question like this: if your son dies, is there need for a college plan? No, there is no need for college plan. The person who's going to go to college is no longer here. But if you die, do you think he wish there's a college plan? Yes. Then who need to be the insurer? Child or parents? Okay. So sometimes they call it self-completion. So even if the provider has passed away, there's a protection. Okay. We talked about long-term care, and we'll talk about it again. We can do long-term care rider with the life insurance, and we can cover two lives, husband and wife, or mom and daughter if you want to. And it covers two lives or single lives depending on your situation, and we can set it up so that the benefit amount will never depleted. It'll the promised benefit amount lasts as long as the client lives. That's one way to do it. One thing that I don't really like about this plan is that the long-term care benefit is reimbursement, not indemnity plan, meaning that you have to incur costs associated with your condition, and it is paying for that cost. But other than that, it is really attractive plan. So if you have a client who need a long-term care, we can provide that also. And we also, I mean, you probably didn't know, but I also have connection with a critical illness. It covers like cancer, it covers a heart attack, stroke, whatever that is. What the critical illness is, just it is a standalone critical illness rider. That's how you should look at it. If you have those specified condition that is written on the contract, that insurance company will pay that amount. Let's say you bought it for $50,000 and you have a heart attack and it was severe, they'll pay that $50,000 and policy is done. You got that $50,000. Okay. And another thing that we can do is a pension and 401k. We can do simple IRA, SEP IRA, 401k, and cash balance plan, defined benefit plan, pension plan, you name it. Okay, so that's another thing that you can do with insurance license only. You do not need a security license. You do not need a broker license for like so that you can handle stocks and mutual fund. You do not need that. I have a company that only let you have all this plan available for you with just life insurance license. All right, that's been a quite handful. So I'm done. I mean, I'm pretty sure I missed some of the other product, but I thought that it would be a good time to really have a bird's eye view of what we can offer to our clients.